The Nairobi Securities Exchange is targeting growth of income from new sources such as data, vending and information subscription services to fill at least a fifth of its annual turnover. It's a strategy to deter the bourse from what is currently an over-reliance on trade commissions and listing fees. So let's head over to our studios in Nairobi. Steve Biko, director at the Hildago Group of companies, is standing by. Is this attempt to diversify revenue streams going to work, Steve?
Yes, I believe the Kenyan market has actually been very unique in terms of innovation and emerging products. We've been able to see that in the financial sphere, actually, new applications have actually been able to come out in the market. And what the stock market is actually doing is being able to take advantage of what's been happening in the digital world in terms of user end appreciation of the internet and basically the use of the mobile phone and the element of data. So what I believe the Securities Exchange new strategy in terms of boosting its bottom line at the end of the day is actually going to work, especially when you realize that a lot of people are able to access data via their gadgets, whether it's a laptop, a phone, a tablet. It's increasing. So few of us actually going to the market on a daily basis. So we'll rather sit back in our private offices and be able to follow the stock market, follow what's happening and things like that. So this is a good strategy for them. However, the challenges, especially in terms of civic education the user and person needs to actually be told exactly what kind of product is going to come in, how it's going to be used, the security element to it. And also you realize that with diversification in terms of real estate, the over-the-counter exchange and the new indices, a lot of education needs to be, a lot of awareness campaign need to be done by the Securities Exchange to be able to prepare the people ready to be able to increase the uptake.
Okay, what we do know is that equities were down over 30% last week, and so basically it means that valuations lower. What could be earned from trading fees was a lot lower, and also, annual listing fees relatively flat because not a lot of companies came to market. What is that going to mean for the balance sheet of the NSE when it looks at its 2011 revenues?
Currently, as we're speaking, the bottom line, the balance sheet for the Securities Exchange is actually not good, and that's why they're actually coming up with a new, different ways to improve the revenue stream. However, when you look at the issue of new listings, it's been flat for at least 3 years, and it's going to be flat for the next probably 2 years, because currently we're actually getting into a new dispensation, a new constitution that's actually changed how we do things. So until we're all able to appreciate how things are supposed to be done, it's going to take a while. Then also when you look at the issue of transaction fees has actually dropped because when you look at the volume trades at the market, they're actually low. They've dropped by at least 37%. So this has made them look at new ways in terms of revenue generation. But the only way that they can be able to sustain normal fees will be when you're looking at the over-the-counter, the bond market. This will actually be 1 full year in terms of being able to earn from this. But also this has been the only government security aspect whereby it's been able to sustain foreign investors into this. This is what many have seen as a stable way of actually being able to generate revenue at the market. Okay,
well, obviously there were 3 new listings last year, and we also know of the corporate bond issuance by Bond Afrique. What is the NSE doing about attracting more companies to market?
What they've been doing is actually to come up with measures that will actually create confidence in the market in terms of regulation, in terms of teeth. Currently, if there are issues, they can be able to handle the issue to safeguard investors in the market, to safeguard the investment. And also 3, looking at policy that will actually make it easier in terms of listing. Like when you're looking at the over-the-counter issue, it's actually the listing fee has actually been reduced, the process has been reduced, the number of licenses or the number of approvals has actually been reduced to make it easier. But also they've increased vigilance so that as they reduce regulation to make it easier to get into the market to trade, vigilance is there to be able to safeguard investors' money.